Hello and a warm welcome to Econoday Unplugged on Tuesday, the 16th of February 2021. Mark Pender's on the US East Coast and I'm Jeremy Hawkins here in London. Particularly since we don't have Brian Jackson with us today, it's not often that we start off with Australia. But there was an interesting nugget in the minutes of the RBA's February meeting released yesterday. It was at those discussions that the central bank announced a 100 billion Aussie dollar extension to its existing quantitative easing programme, which is due to end in April. And that despite a clearly more optimistic view of domestic economic conditions. So why did they do it? Well, it seems that they were concerned that if they didn't, an already strong Aussie dollar, and we're talking appreciation of more than 30% against the US dollar from last March's low, the Aussie would appreciate even further. So in other words, quantitative easing has become a means of trying to control the exchange rate rather than simply trying to ensure stability in financial markets in order to help the economic recovery. Which begs the question, if the RBA will go down this route, which other central banks might follow the same sort of path? Could we even be about to enter a currency war? So, Mark, quantitative easing, of course, is down to the Fed, but we do have a new administration. So, do you think Janet Yellen at the Treasury might have something to say about where the dollar should be trading?
I think she already has, and she's said it. Should move to whatever the market conditions are. That it's fairly priced. But in case that there's any large swings, of course, then that kind of hands-off approach would, I guess, be in question. But run through it for us how QE affects currency.
Well, I guess the main driving force is the simple expansion of the monetary base, and we've seen money supply increasing across so many countries as a result of the various central banks' intervention programs. Rapidly expanding money supply tends to have the effect that excess liquidity at home ultimately starts to filter overseas. And so as that money starts ending up into Swiss francs or British pounds or Japanese yen or wherever it might be, it tends to put downside pressure on the currency it's leaving. So, for example, one reason it seems why the dollar is relatively weak at the moment is the fact that the Fed's quantitative easing program has tended to be more aggressive than so many other central banks. So it's had a disproportionate downward effect on the dollar versus let's say the Bank of England on the pound or the ECB on the euro.
Interesting. Okay, so competitive devaluations could just turn on how big your QE is.
Yeah, and it's going to be interesting, I think. I mean, I know we kind of touched on this in previous podcasts occasionally, but I suppose now with so many governments trying to look down the road and think, right, we do have a chance of perhaps a sustainable economic recovery now with this vaccine rollout, gradually being delivered, obviously in some countries more quickly than other. So what they don't want to do is to rock the recovery boat by suddenly seeing their currency appreciate rapidly and hit their exports and further dampen down inflation, which, let's be honest, for most countries at the moment is still well below target. Now, the G7 is supposed to have this agreement not to target foreign exchange rates, but as I recall, the outgoing Trump administration listed at least Switzerland and Vietnam, if I remember rightly, as currency manipulators, and had a number of other countries, including China, on its watch list. So you do sort of wonder if it's not a problem for the dollar at the moment, of course, because it's weak, but were the dollar to start strengthening significantly, would it become an issue, do you think, for Biden?
Yeah, it could. Exports, U.S. exports are weak. I'm just looking at the latest data that we have was for the month of December, and they were still down just over 10% year on year, and that equates to about no change for imports. During the pandemic, demand for exports relative to imports, which were still very kept up during the pandemic, U.S. demand for foreign goods kept up, but not foreign demand for U.S. goods. So, but that has been such a long weakness for the exports. Really, if it's going to, it ultimately has to tie into the labor market. So if U.S. Major exporters begin layoffs or something like that, and they're blaming weak foreign demand, that's probably when you would see the dollar pop up. But it's like it's a non sequitur. It's an invisible factor in U.S. Policy discussion, and it's been that way for quite a long time. But in general, you follow the currencies closely, Jeremy. I mean, they haven't made a lot of headlines lately. They seem to be behaving international currency levels, or how about the emerging markets? How are they doing right now?
Well, on the whole, the emergers currently have been doing pretty well, because I think we're living in this world whereby I think investors generally don't seem to be overly concerned about the economic outlook, because they particularly now believe that there will be a solution to the COVID crisis courtesy of the vaccine. So a lot of the the smaller currencies are actually doing well. Although, I mean, fair enough, we can't class the likes of the Australian dollar as being an emerging market currency. Nonetheless, it's one of the more peripherals to the major currencies. And it's certainly been appreciating rapidly compared to where the authorities would like to see it. It's led to a massive increase in some of their export charges, well, it's their import costs for other countries, but then their export prices for the likes of iron ore and so on, which of course the economy crucially depends. And it's quite clearly become a major issue for them. Now, I think within Europe, well, we got the ECB, which strictly speaking, as Christine Lagarde said at their last meeting in December, they don't target the exchange rate. And for a long time, the exchange rate is hardly featured in their bulletins. But certainly over the last, 2 or 3 meetings, the euro has got a mention, and it's gone from being something which we monitor to the last meeting, which suggested that we'll be monitoring it very carefully going forward. I know it's just adding an extra word or so in terms of what they were saying, but it kind of hints that, well, look, perhaps this euro is starting to get to the sort of levels that we don't want to see being exceeded over the course of coming months. Because we talked about so often inflation in the eurozone, despite its January bounce, remains well below target. I mean, all the measures of inflation that they look at are nowhere close to their near 2% target. So they really don't want to see a stronger euro, both hitting growth, but of course putting additional downside pressure on inflation as well. But I think one interesting issue of this, I suppose I should quickly just mention in terms of Europe, as far as the UK is concerned. I mean, our experience with exchange rate targetry has been a total disaster when they tried putting the pound into the exchange rate mechanism of the European monetary system. So the forerunner, if you like, to the current euro. It didn't last very long, and the pound had to be pulled out of it in Black Wednesday back in September 1992, and that, I must say, burnt a lot of bridges as far as FX targeting was concerned for UK authorities, and they now pretty well just let it do its own thing. But I wonder if the other question about this, if we just generalize a bit from the Australian situation, and does it then start becoming the case, well, take the RBA, perhaps they wouldn't really have introduced additional quantitative easing, bar the fact they were concerned, as they say in the minutes, that a number of other central banks were, had either stepped up central bank quantitative easing, or they're extending central bank easing. And so they were concerned if they didn't kind of match it, then the Aussie dollar is going to start to appreciate. Well, if you follow that route generally, it means then if another central bank thinks it should be easing, introducing additional quantitative easing, you start doing it as well, even if domestic economic conditions don't warrant it. Therefore, surely that must place additional risk of some kind of asset bubble, which could cause big problems further down the road.
Yeah, okay, but for the U.S., I don't think it would. The currency would begin to, be more important than the economic conditions, especially the labor market. That would be the fundamental concern. But unless you say there's some kind of a dislocation that begins to appear.
I guess, I mean, because as you say, you're compared to, well, certainly a country like the UK, for example, the US is a relatively closed economy. Exports and imports have a much bigger share of UK GDP. So it kind of means that the US, given the nature and structure of the economy and the importance of the dollar anyway, it can perhaps do its own thing. But it increasingly perhaps means that where the Fed leads, other countries may have to follow suit, unless they want to see the dollar weaken even further against the pound or against the euro or whatever it may be. So the potential dominance of Fed policy becomes even more important than perhaps it is already.
Well, I think that, the policy path for the Fed looks to be some kind of a tapering later than sooner. But considering the decline we're seeing in COVID right now, that I think that would be the assumption, which would then be something that would tend to strengthen the dollar, you would guess. Um, but then, there's also these asset bubbles, or the risk of these asset bubbles out there, and as they burst, they could have their own, effect on the balance of these different factors.
Yeah, definitely. And I think you have a tapering one's going to be really interesting because you say, as and when the Fed starts to taper, kind of ignoring what's going on elsewhere in the world, you'd have thought that should be a plus, a positive factor as far as the dollar's concerned. But it may well mean that until such times the Fed does start to taper, other central banks which might want to taper will feel reluctant to do so, because if they were to start doing so before the Fed, then the Aussie dollar, whatever it may be, appreciates even further. So it may be, again, what happens to Fed policy kind of lays down the, sort of the parameters as to what can happen to, central bank policies elsewhere.
Hey, what do you think is going to happen with the old G7s and all these things now that Trump's gone? Have you heard anything? Are they going to start meeting again?
I don't know, but I think certainly, I mean, obviously, you know much more about what Biden's likely to do than I do, but I think from what's coming out of Europe, there is some sense of relief that Mr. Trump is no longer sitting in the White House. The initial perception is that Joe Biden, although he's clearly going to be his own man, and we wait to see what his foreign policy, etc., is going to be. But I think there's a sense it's going to be much easier to have a dialogue with him and discussion, and perhaps come out with joint policies, and it
Exactly.
would be the case under Trump.
That's what I was thinking of. A G7 announcement on currency policy or something like that used to be what we would get. And maybe they can return to some if these issues emerge.
Yeah, maybe.
Yeah.
I mean, certainly it's interesting. I'm just looking at euro dollar. I mean, as I mentioned earlier, we've had these comments coming out of the ECB, which has certainly got investors that much more cautious, I think, about buying the euro. As you mentioned earlier on, the euro dollar hasn't really done much over the last several weeks, if not months now. And one reason behind that may be the fact that the ECB has made enough noise to affect, look, we're monitoring this carefully, that would-be buyers of the euro are being that much more cautious. But it should be said, if you look at the long-term average of a euro, and I quickly did that before we started this podcast, over the last 20 years, euro dollar average is 1.206. And as you record this, it currently stands at 1.216. So to all intents and purposes, it's pretty well bang on, where it's averaged over the last couple of decades. So I think for the ECB to be making noises about the euro being too strong, or kind of hinting something like that, it's probably taking it a little bit too far anyway.
In that range over that you were talking about 20 years, what was the range from 1.1 to 1.3 or something? It would be pretty narrow, wouldn't it?
Well, the high point going back to 2008, if I remember rightly, I think euro dollar was around about 150 or so, something like that.
It got that. Oh, okay.
Well, that of course was during the onset of the initial global financial crisis, when the first reaction was to hit the dollar, before all of a sudden it became, oh, hang about, the dollar is a safe haven currency, so everyone started piling back into it again. So over that period, it was extremely volatile. But outside of that, by and large, I think because we have so many central banks being ultimately very successfully managing down inflation rates, you think where inflation rates used to be, let's say 20 years ago, bore no resemblance to where we are now. So the reduction in inflation rates has also helped to bring about less volatility as far as the foreign exchange markets are concerned.
Well, currency volatility was kind of tested with Brexit in the UK and sterling, and the various factors flying around for the last several years that have all, coalesced or something into what we're in now. How would you characterize sterling volatility over the last several years? Now, just as an observer, I would say it was to get the ball rolling. It seemed to me to be, there was definitely some of it, if not a lot of it, but it could have been worse.
I think that's right. I mean, looking amongst the major currencies, the pound has been probably amongst the most volatile, if not the most volatile of the big G7 majors. But the pound is, I mean, it's open to a whole range of so many different factors. I mean, crucially, as you mentioned, I mean, Brexit saw one of the biggest moves we've ever seen in the pound when we had the referendum vote back in June, 2016, and we saw the pound quite simply fall out of bed against the dollar. I'm trying to remember off the top of my head now. I think when the Brexit vote was announced, I think sterling dollar was trading at around about 144, 145. And by the open of the next morning, it had fallen below 130. And it kept on going.
Does the Bank of England, is it in there smoothing things out?
I think behind the scenes, it was probably trying to smooth things out. But I think it also took the view, well, look, this is a major, shock to the system. Let it sort of settle down first, and we'll see where we end up. But I think certainly the bank was making noises to the effect that we are standing here prepared to do whatever we need to make sure that financial markets continue to operate, successfully and stably and so on. But going beyond that, I think the pound and, well, really a lot of other currencies, it's been interesting looking at the metrics, because we spend so much of our life talking about and writing about economic numbers. But really, ever since the arrival of COVID, it came to the case of, right, well, what are the latest, daily new COVID case in whichever country? And the higher the number, the worse it is for the economy, so the worse it is for the currency. Then it started progressing towards, okay, so who's going to get the first vaccine to be released, and then the rate of delivery of the vaccine. And I think if anyone were to ask me at the moment, well, why is sterling trading almost back up at 140 to the dollar again? So we're talking about back to multi-year highs now for the pound against the dollar. Really, it's because the UK authorities, through luck or good judgment, have been able to get hold of so many vaccines, and the delivery process has been working exceptionally well. And so the UK now, all of a sudden, having been one of the worst performing economies, certainly amongst the big economies during 2020, now people are starting to think, well, it could be one of the first countries to emerge, and second half year growth in the UK perhaps could be very good. So who knows, perhaps it will be the UK, the Bank of England, which ends up tapering its quantitative easing program before most of the other central banks, which again would be a plus factor for the pound. So I think you're right. I mean, there's just so many different issues influencing currency markets at the moment, but the likes of the pound, I think, still tends to be amongst the most volatile.
Well, but given the economic importance that COVID has, how would you describe the UK policy? Was it an NHS, National Health Service? Did they manage this, or was this managed outside of the health service? Who's the brains behind the success?
Well, it's a combination of government advisors. They have an outfit called, appropriately enough, SAGE. Don't ask what it stands for, I can't remember. But it's a load of very bright scientists who do the mathematical modelling of what's going on with COVID, what would happen if we, start introducing vaccines, etc., etc. And also the NHS, which have been part of all these discussions and also ultimately responsible for delivering the vaccine. But I think the crucial move that the UK undertook was to decide very early on that, okay, we've got a major problem here. How do we solve it? And their answer was we're going to front end purchase as much vaccine as we possibly can do. Doesn't matter what the price is, we're going to buy it. So the UK managed to get hold of an awful lot of vaccine, I mean, enough for the whole country, and pretty well before anybody else did. Whereas looking across the English Channel at what was going on in Europe, the view was, well, look, this is the European Union, therefore everything has to be centralized. And it meant that for whatever reasons that the whole vaccine process has been desperately slow, to the extent that for a number of politicians now who are looking over their shoulders, wondering what it's going to mean for them. So in Germany, as we talked about, we've got these federal elections coming up in September. Now, Angela Merkel won't be around anymore because she'll be finishing her term. But the current administration has taken a lot of flack for the slow delivery of the vaccine in Germany. In France, where again the delivery of the vaccine has been exceptionally slow, President Macron does elections in France next year, and he's getting an awful lot of flack for the fact that not enough people have been vaccinated there as well. So it's quite interesting. This whole COVID issue is actually potentially starting to change the shape of how the political landscape could lie over the course of the next couple of years or so.
How about the monetary landscape? Is being slow in COVID mean you're going to do more QE?
Well, yeah, I mean, you're perfectly right at the moment. If you think about it, right, how do we get out of this mess in terms of COVID? Well, it's got to be through the vaccine. So if you got the vaccine being rolled out quickly, presumably your chances of recovery are relatively good, subject to mutations of the virus and so on and so forth. But for those countries like Germany, Italy, Spain, the rollout has been so slow that we're starting to see it begin to impact some of these sentiment indicators now. Back end of last year, when the vaccine started to become widely available in different amounts to different countries, there was this general sense of optimism that, well, hooray, perhaps this is finally it. This is how we get out of this coronavirus mess. But what we're starting to see now is that a number of particularly European countries, you're getting some weakening in sentiment about how long is this going to take now because the delivery is too slow. And if that is the case, as you say, all it means is that if the COVID numbers stay high because the vaccine's being rolled out too slow, the lockdowns will be extended, and the more the lockdowns are extended, the worse the economy is going to be. So think, where are we? Just a few days ago in Germany, they announced that another extension of their current lockdown that was supposed to end in early February is now going to run into, I think, at least early March. So that is another month on that. We've still got curfews in France. We've got, well, effectively various forms of lockdown in place across most of Europe, and where they're being changed, it's almost as if they're having to be extended, rather than people thinking, well, it's okay, we've got a chance to start easing some of the restrictions now. So yes, I mean, COVID, I think, is going to have a hugely important impact on what happens to policy. So how are things go on your side? I mean, how much does the Fed, when you get the minutes of the meetings and the various commentators, how much time do they spend talking about, right, COVID is doing this to the economy, hence we need to do this?
They have these, they talk about it like the yin and yang. It's like these two different, what is likely to happen, or what is happening, and then they take the other side. And so they balance it out. And it always tends to have like this middle ground feel, like, I guess they do that to not overstress anyone thread of argumentation, but you can see it a little bit. It's like, so they'll say some of the members, I guess there's 18 members now. So some of the members said this and a number said that,
Yeah.
So you can guess on what they're doing. They don't try to make any medical conclusions. They stop well short of that, saying that that's for the healthcare industry.
Yeah.
But they definitely talk about infections and the pace and mortality and their effects on the service sector, or what this whole COVID lockdown is doing to that and to the labor market especially. So the U.S. has a big. Oh, I saw the French ILO employment today. Was that today? And that's a quarterly, fourth quarter.
That's
and
quarterly number, yeah.
It came down. I mean, the U.S. I mean, it's coming down too, but there's 10 million people who are just not in the labor force anymore. So something like France, did they lose a big chunk?
Yes, they did. I mean, and to be honest, the numbers looked almost just wrong. I mean, it came down a full percentage point. I mean, the total, the ILO rate came down from 9.1% to 8%. But as the stats guys themselves admitted, a big chunk of that was really due to, the impact of the second lockdown. And a lot of people just simply left the labor force. So that mathematically brought about the big fall. But again, it's also a reflection right across Europe, where at the end of the day, the unemployment rates, typically speaking, are a lot lower where most people thought they would have been, let's say, this time last year. Well, around about when COVID first hit, simply because the massive amount of support programs which have been put in place, which is still a big issue for so many of these governments as to what's going to happen once these support programs are removed. Right, since we moved on to economics, before we talk too much and people all nod off, last week we talked a bit about inflation, how the markets were getting concerned about it. You had January CPI out the States last week. What did it tell us?
It was mixed. Let me. The core was weak. Let me get that up on my Econoday calendar. The core didn't show much life at all. What we did get was inflation expectation readings from both the business level and the consumer level. They were mixed. The consumer one shooting up. It's a volatile reading. This is from the University of Michigan. So it's hard to make much of that. The business inflation expectations were steady, but they had jumped earlier in January. Anyway, so the CPI for January came in at 0.3% overall monthly gain, which was the Econoday consensus, but the core came in unchanged on the month, and that was 0.2 below expectations and below Econoday's consensus range, where the lowest estimate was a 1/10 gain. On the year, the rate fell 0.2 to 1.4, so it's going in the wrong direction. And this is really if you can figure this out, tell me. But we have all these home prices shooting through the roof, 10% basically on the most conservative measurements on the year. But you don't see housing costs in the CPI doing anything but declining at they're plunging actually in how fast they're slowing. And they're slowing both for rents and they're slowing both for homeowner costs. So, and you have to go back to the subprime crisis 12 years ago to see anything like this, a big slowdown. Then it dropped into contraction, these readings. But right now, and these are 40%, or a significant share of the CPI. So as long as homeowner costs are flat or are slowing, or just maybe if they even move into contraction, well, that's going to take the CPI right through the floor. So Now, why do you think home prices can be soaring at the same time that costs, it's low interest rates, that costs are going down?
Well, I assume that's it. I mean, presumably we're seeing the asset price bubble from the equity markets, spilling over into the house market. We've had the same sort of things, but to a much lesser extent in Europe and in the UK as well. But I guess, depending upon how they actually measure the cost side of it, if it is just due to the fact that, borrowing costs are effectively at record lows almost everywhere, that's helping to keep down, the cost of ownership. And that is that part rather than the actual cost of the house itself, which is feeding through into the CPI. And as you say, helping to keep it as low as it is.
Yeah.
Okay, what I should quickly mention from my side, I guess the main numbers we had out were within the UK, and for the fourth quarter GDP, we finally got the UK numbers, which were came in a bit late and better than expected. We actually saw a decent 1.0% increase in fourth quarter UK GDP, which was a little bit better than expected. But we're still looking for a contraction in the first quarter, so it's you win with one hand and take it away with the other. For Eurozone, the fourth quarter there was revised earlier on this morning. That now shows a 0.6% contraction on the quarter. That leaves it down 5% on the year. It should be said, though, despite the fact that the fourth quarter UK number looked quite good, we're still talking about a hefty contraction, 8.1% year on year there. So, bottom line is that at least the second half of last year, the UK was one of the weakest performers of all of Europe.
So the year-on-year comparison for Q4 GDP was minus 8.1 for the UK. And for the Europe, what was it, minus 5?
And for Europe, it was, what would I say? Europe, it was down, I can't see me notes on that. Why is it you can't find it? Yeah, down 5%. Yeah, at least you were listening. If I was doing it, I was talking.
That's an interesting comparison. So what do you make of that?
Well, it's quite interesting if you're looking across it. On the UK, it had one of the steepest collapses in output and demand in the second quarter of last year after the first wave of COVID, and it hasn't really recovered from it. It's certainly started to do better now, and the vaccine rollout is starting to have some impact on the data, I think, but there'll be much more of that to come through. But it's certainly the case that I think although they handled the vaccine well, they were too slow getting the lockdowns in, shutting down the economy to international travellers and all this sort of stuff. And so the UK seemed to suffer disproportionately. So
I have a quick question on next week's UK data. I think the labour market reports do. For the and it seems to me, can you tell everyone how do the markets trade on the UK employment report? The reason I ask that is because it doesn't seem to be the most translucently obvious, transparent set of data.
No,
it seems that they seem to be doing the opposite. They try.
You're very right. I think everyone is so used to, oh look, it's Friday, it's US employment day, and the world sort of comes to a stop because everybody looks at it. When it comes to the UK employment report, I mean, it's never had the same effect. That never been as significant as the payroll data, etc., from your side. But it does seem that of late, and the report itself, I mean, it's a right nightmare to go through. There's so many different measures of unemployment, some of which are classed as official statistics and some aren't. But the unofficial statistics are more timely, so do actually put more weight on those than the official ones. And it really is a complete mishmash. And it's a nightmare to actually try and extract the information you really want to from this report. And I think partly as a result, I mean, investors look at it, because at the end of the day, we know that how the labour market is performing is very important to the Bank of England. They've made that patently obvious. The problem then, though, is you listen to what the Bank of England says. Essentially, it's saying they don't believe the official national statistics labour market data in the first place.
Wow.
They tend to take that and adjust it according to what their regional agents are saying.
When they don't believe it, they say it's not measuring what people who are out of the workforce and that kind of thing.
I mean, the Bank of England's belief is that the true, whatever that means, the true underlying unemployment rate in the UK is higher than what the ILO estimate is. So they're talking about currently 5% in terms of the official statistics coming out of the Office for National Statistics. I think the Bank of England think it's more than 6% at least, if not higher than that. So how financial markets supposed to interpret this stuff? All you can do is, well, look, the expectation was this. If the unemployment's higher than that, it's presumably worse than expected for the economy, and the pound may come off a bit, and perhaps the gilt market might rally. But it has nothing like the same impact over here that your side employment situation does.
For the UK, what single indicator has the most market moving impact?
Well, you won't like me saying this because I know you're not a big fan, but I have to say Friday we'll get the flash PMI out of the UK and out of Europe, and they have become over the course.
Wait, the UK has a flash? Oh yeah, of course it does. Right?
Yeah, we do. We didn't used to have one, and then we got one. And these flash PMIs now, they really are. They're used as the benchmark because they're whether you believe them or not, they're up to date. They carry relative as near as you can get it real-time information, and that's what investors want. And to be fair, they don't tend to be revised. Not sure about your side, but over here, the flash PMIs don't tend to be revised very much. Oh. So there we go. I don't know about you. I'll just round off my little bit. I should mention Italy, since Super Mario is back and in position. So Mario Draghi, the former ECB president, was sworn in as the new Italian prime minister at the back end of last week. So he joins with the Italian economy being one of the worst performing economies of the Eurozone. It contracted a quarterly 2% at the back end of last year and needs a lot of help. Now, he's come in with a view to getting hold of an estimated about 200 billion euros worth of EU recovery funds to spend on the Italian economy and get it going again. But he does have to come up with some structural reform program which satisfies the EU's Commission's demands. Now, he's got behind him his new so-called rainbow government, so he's got effectively a broad spectrum of the political spectrum is part of his government. But since all of them seem to hate one another, it would going to be interesting to see just how long Mr. Draghi can last. So he's called Super Mario, having saved the euro. And I do reckon personally, if he's still in situ once we get to the next general election, which isn't due for another 18, 19 months or so, then he'll have earned that title because it's not going to be an easy job. And indeed, it's quite interesting. We did see the Italian financial market, particularly the bond market, decoupling from the shakeout we saw in most bond markets when his potential accession was announced. But since he's been installed, we've seen bonds giving back some ground, and perhaps a sign already now the initial honeymoon period is over. He's really going to have to earn any credits he gets over the course of the next several months.
Well, the honeymoon, but they've been. Is it 200 billion euros that are going to be doing?
On paper. That's kind of it's a lot. Yeah, it's disproportionate.
That's a lavish amount of money. It has to make the Italians happy. What's the whole Euro fund itself was 750?
Well, that's part of it. That's kind of the main package, but it actually goes above 1 trillion once you start adding in various other programs they got around it. The kind of, the 750 is kind of the market focus number.
Is Germany taking any?
Germany will get some, but it's going to be peanuts compared to the likes of Italy, and also Spain will get a lot. Portugal will get a lot as well.
So that has to give them a lot of goodwill. I mean, dividing it up, that not everyone may think that they're going to get their share, but it seems like a lot.
It is. The question is, have they got to prove to the EU Commission that they're going to spend it the right way? And they're not going to frit it away on the irrelevant programs. It's got to be on your infrastructure, on green measures, et cetera, et cetera. And indeed, it looks as if, just from some of the comments coming out of the Commission earlier on today, as if this package isn't really going to start to be dispersed until into the summertime anyway. So in the meantime, it's still the case, if they're going to get help, it's either going to be local economies, it's going to come from national governments, or it's going to have to come out of the poor old ECB again. Okay, anything else from your side?
Yeah,
we've cracked on far too long.
Well, I just was thinking about the composite flashes that are up at the end of the week, and I have been looking at them, and it seems to be a general, the usual forecaster consensus, which is little change from the prior month, whether they're right or not, which generally is for services, at least in Europe, to be behind. Manufacturing, but for the U.S. to pretty significant growth for both. And let me just, one last thing is that you were talking about the UK composite flash being the big mover for the UK. That last flat, the services reading that fell under 30, that fell under 40. They don't see much of a bounce back, just a couple points, just at 40 or so. But and then that's complete lockdown effect.
That's it. Yeah, I mean, so with a bad number last time, but the latest lockdown, because they actually started easing some of the measures temporarily in December. But since the beginning of the year, though, we've had a full lockdown being introduced, and that's become sort of basically, so it's become more entrenched as we've gone through into February time, and that's why.
So the lockdown was worse in February than it was in
Well,
January?
it's not meant to be worse when people has got more used to it, and so you saw the big collapse coming through in January, and really no one's expecting any proper improvement until it starts.
Well, it was just a moment on the methodology of that question. Is a question to the UK service providers. It's a February. They may be doing those questions as we speak right now, and they're asking the respondents, if you're a service provider, how are new orders right now compared to where they were last month? So if they're both lockdowns, you could argue that a 50 reading would be what you could get, because there's been no
change from a low level.
No change from what was already severe lockdown. But that's not what's expected. They're actually calling for further contraction, although at an easing pace. I just wanted to point that out.
Yeah, and that's exactly right. It may well be that some of the orders which were in the pipeline, the few they had, have been used up now. So there's kind of nothing left at all.
So a little bounce back wouldn't be that great of news, is all I wanted.
No, I think you're right. If it came in at let's say 49% or even 51%, the risk is that some people start thinking, 51%, that means it's growing. But it's growing, as you say, from such a weak level that you wouldn't really notice it if you're in a part of that sector anyway. Okay, then let us wrap it up there. On behalf of Mark and myself, as always, thanks very much for listening. We'll be back again next week. And in the meantime, you can keep up to date with all the key market moving data and events as ever in Econoday's global economic calendar. We'll see you next time. Bye for now.